Good morning, everyone. You are watching a live daily market outlook for Monday, 26th of March, 2012. The beginning of a new week shows the US dollar trading off its past 10 days lows against the yen and basically against the other majors as the movements against the Japanese currency show some corrective action as Japan importers are taking profit after finding some technical support. But however, the larger picture of dollar yen is still keeping the US currency turned towards the downside, as this is possibly beginning of the major correction of this short to medium term rally from 76 that picked up at 84.17. Even though the dollar rally against the yen has lost a bit of momentum, the dollar is still strong in the near term, and if it doesn't break below 81.96, which is the recent low and the support, the possibility of a stronger bounce higher is still in play. The euro is off its session highs, moving around 132.50 zone after hitting levels at around 132.80 during the Asia, keeping the positive structure of last week's low at 131.32 and the part of the broader bounce of 130.00 higher base of the mid of March. A similar situation is with the sterling, while gold and the oil actually got some support and recovering a good part of the recent losses. The gold made the worst week since August 2011, losing from its losing the biggest part of its recent downtrend of 1790, but recent near-term recovery of low at 1628 posted last week is now on a good path for further recovery. The gold is are actually pairing gains to the near the previous closing price, with investors now closely watching the oil and the currency markets for further cues of their trading. The bullion actually posted its biggest one-day rise so far this month last Friday, as this is a reflection of the higher oil prices and the sharp fall in the dollar as a result of disappointing US housing market released last Friday. The oil price is now supported by shortage from Iran, Syria, and the latest South Sudan and Yemen that are now supporting the prices, generally supporting the prices, as Iran and Syrian problem persists for quite a long time now. The Sudan and the Yemen are the new ones, and the oil bounced again of its recent lows, hitting levels of our range, recent short-term range ceiling at 108.20. There was a spike high last Friday. 108.22 was hit ahead of current easing, stabilizing at levels above 106. From the Europe, the European politics can move like a waltz, though rarely as gracefully. Leaders take one step forward, one sideways, and occasional twist as they make gradual progress towards resolving the Eurozone sovereign debt crisis that is pressuring the whole Euro bloc in past months. The next date of their dance card is Copenhagen, and the end of this week, where the European Union leaders will meet to discuss increasing the size of Europe's new bailout fund, with recent data showing the still fragile European economy and debt yields rising in Spain and Italy. The EU leaders can ill afford to stumble. A fellow group of 20 members are insisting the EU build a fund that is large enough to prevent contagion from spreading to more Eurozone countries, but German debt is bulking. Agreement is far from assured in Copenhagen, though a senior German lawmaker has said Chancellor Angela Merkel, facing difficult regional elections, might offer a short-term increase in the European Stability Mechanism's 500 billion euros fund. The investors at the least want to see movement, as the failure to increase the resources or make some progress would be a reminder of Europe's political inability to get ahead of this crisis. That would also prove damaging, especially after purchasing managers' index for March showed manufacturing contracted unexpectedly in Germany and France, the Eurozone's two biggest economies, as well as oil prices climbing to the new highs, and Spain's debt problem is now deepening. Basically, the Eurozone is in the volatile environment, and things could change very quickly, either in the good sense or in the bad sense. The batch of weak data from Germany and France was a reminder that the wave of optimism that has washed over financial markets recently was largely a reflection that risks from Greece have abated, not a vote of evidence in the economic outlook. Warnings of Europe's continued fragility came from Spain last week, when the yields on its 10-year debt touched 5.5% for the first time since early January. They climbed after Prime Minister announced a grimmer fiscal outlook and cut a deal with Brussels to relax the budget targets. There is also a general strike called for the coming Thursday by Spanish unions, and will be the first major street test for the government's austerity plan and economic reforms, which have weakened union influence over wages and work conditions. Italy's 10-year yields also rose above 5% last week for the first time in 2 weeks, as the government forges ahead on labor market reforms. The cabinet late on Friday backed sweeping measures viewed as critical to reviving its economic prospects. The Prime Minister Monti still faces a battle in Parliament, but ministers are talking tough, using Bacchus or Sakas rhetoric, and none of the parties who has a vested interest in collapsing the government. A vulnerable Europe and weakened China, where the factory sector shrank for a fifth straight month in March, leave the United States the main driver of global growth, but its performance is far from impressive, trending around 2% in the first quarter. The U.S. durable good orders for February, due on Wednesday, are seen raising by 2%, excluding the volatile components of air and defense, which would be a welcome relief after January's decline of 3.9%. If personal spending for February comes in at approximately 0.6% that are due on Friday, as analysts are forecasting an incomes adjusted for inflation rise, it would signal the U.S. economy is poised to gain momentum. Job growth, debt pay down, and the low interest rates have strengthened the American consumer, the backbone of its economy. But 17% rise in gasoline prices this year is hurting American budget and eroding the consumer confidence. From today's calendar, very few things as usually. On Monday, we have the thin calendar. The focus on the day is on German's IFO business climate that is forecasted at 109.7, slightly above its last month's release at 109.6, and it's due at 10 o'clock. It's due at at 7 o'clock, 8 o'clock GMT. I do apologize that the time has changed now, and I'm not quite sure. While U.S. pending home sales are due at 1300 GMT, and the 1% increase on a monthly basis is expected compared to raise of 2% in the previous month. Meantime, the Fed Chairman Ben Bernanke is due to have a speech at 11 o'clock GMT, while ECB President is due at 1500 GMT. Late in the evening, we have a couple of other speakers. Bank of Canada Governor Carney is due at 1600 GMT, and late in the European session at 1945, we are going to have the MPC member Miles having a speech. Now we're going to take a look at the markets and see the latest movements in the major currencies and commodities. We are starting with the single currency against the US dollar. As we can see on the 4-hour chart, the euro dollar remains in the steady gains of 130.00 15th of March high, with the latest leg higher of last week's low at 131.32, and now testing the recent range ceiling at 132.80 zone, which was last tested on the last Friday when the pair briefly ticked higher at 132.92, but quickly reversed lower. This is just ahead of next very strong supports at resistance, pardon, at 132.90, which is the high of 8th of March, as well as 133.00, the 61.8% Fibonacci retracement of 134.85 to 130.00 descent, and basically break of these levels where the pair remains congested for now would signal further resumption of the short-term uptrend of 130.00 base and open levels at 133, 133.31 and 133.55. The next static resistances failure to break these levels might see further ranging, but so far the hourly and 4-hour studies remain well supportive. However, the hourly ones are losing momentum and losing traction, as the pair that was initially supported during the Asian session at 132.50, which is the main bull trend line drawn of 131.32 low. And now my signal further easing before the bulls reassert, as the 4-hour studies are still in the positive territory and still see potential of the further gains. Next support is dynamic support 132.36 55 days exponential moving average, ahead of static ones at 132.20, 132.00 zone, while loss of 131.89 higher low of 23rd of March last Friday might weaken the current structure. However, as long as holding above 131.32 last week's low, there is potential for further development towards the upside and possible test of our key barriers at 132.80, 90, 133.00, while only loss of 131.32 would weaken the structure and keep the upside intact for now. Sterling roughly follows the euro and its movements as it bounced off last week's low at 157.69. The significant point was last week's weekly closure above 200 days moving average, briefly above, but still above. That might be signaling some stronger action towards the upside, as the pair remains, as shown on the daily chart, congested with this within this 156, 159.90 range, with the recent range ceiling of the near term at 159.22 still cupping the upside. This was the high of 21st of March 2012. Sustained break above 200 days moving average might keep the upside in focus, as the daily studies are improving now and attempting holding above their midlines, keeping the potential for a possible test of initial barriers levels around 159 and 159.20 to possibly open 159.90 peak of 29th of February, break of which to signal a break above this short-term range in past 2 months that is limited on the downside at 156 and on the upside at 159.91. Back to the lower time frames, current pullback of overnight's high at 158.82 is now approaching midline, trend line support at 158.50, level break of which to open way for some stronger correction of the latest upleg from 157.69 with next significant supports at 158.20, 158.00 break of which to refocus 157.69 and keep the near-term price action and the tops away out of reach for now. That might signal further ranging. Only loss of 157.69 is to basically weaken the near-term structure and open lower levels for test where we have 157.45 and 157.00 previous strong resistance zone now acting as support. On the upside, holding above minimum 158 would keep the prospect of further correction of further gains and the possible test of recent highs at 159.07, 13 and 22 break of which to refocus 159.91. The dollar yen is currently in the corrective mode after a brief break below 82.00, hitting 81.96. Basically, this is the break point for dollar yen, 81.96, 86 zone. We have the previous highs of 2nd of March 2012 and lows at 81.95 of 13th of March and last Friday. And so far, this has offered good support for the pullback of 84.17 high of 15th of March and the lower high at 84.08 posted last week on 21st of March. Also, the main bull trend line of 76 base has briefly been dented, but the price action bounced higher above the trend line, keeping it intact for now. On the near term, the studies are gaining momentum, the hourly studies of 81.96 last Friday's low, still 55 days moving average on the hourly chart, currently at 82.76, which was the high of the Asian session, keeps the upside capped ahead of the next significant barrier at 82.94, 83.00, above which to open the next significant levels at 83.30.40 zone, 83.30.50 zone, I would say. Only above which is to avert immediate downside risk and keep the downside protected in the near term in favor of a possible fresh attack towards 84 zone, 84.08 and 84.17 recent highs. On the 4-hour chart, the studies are still negative as the price action is held below 20 days exponential moving average, currently at 82.86, that is attempting to cross below 55 days moving average. They are approximately at the same level now, with clear break here to keep the current near-term corrective action capped in favor of fresh attack to 81.96. A break below this level is to open more significant correction, and as this is also close to 23.6 of Fibonacci retracement of the 76 to 84.17 rally, and basically the clear break here to signal a reversal and open the next static break below these levels, and as mentioned, 81.86 and 81.65 break point to open 81.05, 38.2 Fibonacci retracement of the entire move, ahead of next strong static support and higher platform at 80.56 zone. The dollar Swiss is also in the near-term recovery mode after hitting a fresh low last Friday at 90.65. Basically, the pair tested a very significant and strong support at 90.70 zone. We have the lows of 90.69 of 8th of March, 90.75 of 21st of March, and the a brief break below this, and also the 9083, which is the 61.8 Fibonacci retracement of the recent rally of an 89.30 double bottom to 93.33 peak of 14th of March. We need to see the clear break here in order to extend the current down move of 93.33 and the open levels at 90.20, 90.00, our next downside target. On the hourly, the situation is improving as the pair is gaining momentum. Studies are still rather negative, but pointing higher with initial dynamic barrier 91.00, the 55 days exponential moving average being tested now ahead of next static resistance at 91.14, and break here to open way for a stronger near-term recovery at 91.36 and 91.50 zone is the next. Basically, the break above 91.77 last week's high is required to avert immediate downside risk and open way for a stronger recovery of the latest down move of 93.33 down to 90.65. This is also close to 38.2% Fibonacci retracement of the entire move, and also the previous high of 19th of March. So we have the quite a strong barrier here, and only break above this level is to keep the downside protected for now, and keep basically the very strong support at 90.70 zone intact despite the brief break to 90.65 seen last week. Any failure under 91.77 might be seen as a lower top creating a lower top and a fresh weakness with the break below this strong support to open way towards previously mentioned levels at 90.20 and 90.00. On the upside, break firm break above 91.77 barrier opens a 92.00 50% retracement, and 92.31 61.8% retracement ahead of static barrier at 92.52 high of 16th of March, above which to refocus 93.33 high of 15th of March 2012. The yellow metal is in pardon, near-term recovery mode after hitting fresh low at 16.28 last Thursday as a part of the broader down move from a 1790 peak of 29th of February, when the gold price failed to regain the next strong barrier at 1800 zone high of 8th of November 2011, and subsequent sharp decline erased most of the recent gains, erased basically 61.8% of the whole rally from 1522 low of 29th of February that peaked at 1790. The latest price action has seen the break below the previous low at 1634, brief break to 1628, where the temporary support was found, with the current recovery now testing first strong barrier at 1666-69 zone, where we have a 23.6 Fibonacci retracement, and the previous high of 19th of March at 1669, as the price is now attempting through 55 days exponential moving average at 1661, with break here required, and also the previous low, pardon, at 1663. So strong barrier to be cleared in order to avoid immediate downside risk and open way for a stronger recovery. 1690 is the next Fibonacci level at 38.2%. Before this, we have the minor resistance at 1677, and on the upside, the more significant barrier is 1700 zone that's acting as a psychological barrier. Also, we have the previous peak at 1709, 1705 and 1716 ahead of 1725, which is close to 61.8 retracement, and now basically only break above this level is to refocus previous highs at 1790 and 1802. For now, any failure under 1716 would be risky for of further easing. However, we need to see break on the downside below 1628 to refocus to then focus again lower and open 1600 as the next psychological support. On the upside also there is 1682, the just ahead of 38.2% retracement. There is 1687 currently, the 200 days moving average that pair broke during the 2 weeks ago, and this actually has significantly weakened the structure and kept the downside in focus. The daily studies are negative with current bounce. We need to see the clear break above 1700 in order to ease the current bear pressure and improve the structure on the daily chart. Until then, the downside remains firmly in focus, while the near-term studies are now gaining strength, and the break above 1669 is required at the first stage to improve the current positive structure of a recent low at 1628 and open way for a stronger correction. Still corrective until 1725, and would only break above these levels to confirm the bottom at 1628 and open higher levels for a test. And the last brief look at the crude oil, it remains well supported of 104.50 last week's low, as the price left the lower top at, higher low at 105.15 last Friday, ahead of sharp rally to 108.22 spike higher, when the price quickly recovered to the levels below 108. Current easing is still seen corrective, as the hourly studies are still in the positive territory, while the 4-hour chart outlook is currentently improving. Basically, the oil price is still moving within the range that is limited above at 108.68, and on the downside around 104.30 zone, with the break of either side to give us more clear picture of the current movements. The recent news were the main drivers of the oil price regarding supply conflict in Iran and the U.S. crude stocks that were mainly moving the pair, but still it's still directionless as long as 108.68 and 104.30 range limits are holding. A break of either side would give us more clues about about the future movements. However, the broader picture for the crude oil shows the longer term trend of last year's low at 76 last year's 4 of October low still intact, as the pair is currently seen in consolidative mode, as long as holding above 104.00, which is the main bull trend line drawn of low of 74.94 from 4th of October 2011, and only break of this level would open way for significant weakening of the recent high at 110.53 posted on 1st of March 2011. Have a nice day.